You may have a lot of questions about cryptocurrencies. What exactly are they? What purpose do they serve? In the near future, will their prices go up or down? Will governments ban them? Although many questions swirl around, you only need to grasp 5 core concepts to answer them all. Once you understand these 5 concepts, you'll grasp the entire cryptocurrency landscape. And the best part is, you don't need to watch 5 different videos. In this video, we're covering all 5 concepts in one go. Let's begin with the very first concept, money versus currency. Up until now, the cash in your wallet, you've been treating it as money. For example, consider a $100 bill. But imagine if today the government announced that after today, that $100 would no longer be valid. Suddenly, the money in your pocket would be worthless. There's an important distinction here. True money has intrinsic value that can never be reduced to zero. Think of a gold coin. Even though you can exchange it for currency, its value is inherent. No government can ban gold, and its worth is recognized worldwide. In contrast, paper currency might not be accepted everywhere. You might have to convert it into USD first. That's why assets like gold or silver, with intrinsic value, are accepted globally. The key point, currency can be manipulated, but genuine money, because of its limited inherent value, cannot. Now, while you can print as many dollars as the government wishes, you can't just print gold coins at home. The government may print more currency, but gold must be mined, and its supply is naturally limited. Moving on to the second concept, centralized versus decentralized systems. The money you use is controlled by your government, which can print more at will, leading to inflation. The ability to print unlimited amounts of currency is a primary driver of inflation. In contrast, decentralized systems, like Bitcoin, operate without government control. Bitcoin, for example, has a limited resource, a limited supply, which means its value is backed by scarcity. Many see Bitcoin as a digital version of gold because both are limited in supply. Without government manipulation, its value is less subject to artificial inflation. So in the coming time, people say that the value of Bitcoin will increase. Now, because no government is manipulating it, there are no regulations in it. To illustrate the impact of centralized currency control, consider when a country like China devalued its own currency. Even though it was a domestic change, the effects rippled across global markets, even impacting the US stock market. This interconnectedness shows that when governments control their currency, the entire world can feel the impact. That is why it is said that necessity is the mother of invention, and the birth of decentralized currency is exactly what led to cryptocurrencies. You might argue that many smaller cryptocurrencies can be easily manipulated. Take Dogecoin as an example. Even though Dogecoin has grown, if a major player or influential figure like Elon Musk makes a move, its price can swing wildly because the market is still relatively small. By contrast, as the overall market matures and grows in size, much like the stock market, the influence of any single entity diminishes. If you'd like a video comparing stocks to crypto, let us know in the comments. The third concept is fiat currency. What does fiat really mean? Some say fiat means fake, and indeed the money we use every day, the dollars, euros, yen, and so on, is fiat money. A few decades ago, a country could only print as much currency as it had gold or other reserves to back it up. Today, however, many governments print money without any asset backing. We've seen the disastrous effects of this in places like Zimbabwe, where reckless printing of money led to economic collapse. Because fiat currency isn't backed by tangible assets like gold, some people consider it fake. My advice isn't just about cryptocurrencies, it's about safeguarding your wealth. Converting your money into assets such as gold or silver, or even securing loans when appropriate, helps protect against depreciation and inflation. After COVID-19, consider how many notes were printed by governments around the world, and share your thoughts in the comments. I've already discussed similar trends in other videos. The fourth concept is digital versus physical currency. A few years ago, many people were wary of digital payment platforms. They worried, what if the digital wallet vanishes overnight? Back then, most people trusted only physical cash because it was tangible and visible in their bank accounts. Let me share a story. A man saved money for years to fund a vital operation and kept his savings in a cupboard at home. Unfortunately, a rat found its way in and ruined his hard-earned savings. With physical cash, there's always the risk of loss or theft. be it by a mischievous rodent or a determined thief. In contrast, digital money, though not something you can hold in your hand, offers security and reliability. Cryptocurrencies, for instance, are entirely digital. You may have seen images of Bitcoin coins, but you'll never physically hold one. That's why digital currency is becoming increasingly attractive. Finally, let's discuss the fifth concept, blockchain technology. While many people may have reservations about cryptocurrencies themselves, there's widespread confidence in the underlying blockchain technology. In fact, even prominent central bank officials have noted that blockchain is a technology worth adopting. But what is blockchain? In simple terms, it's a ledger, a way of maintaining an unalterable record of transactions. Your bank keeps track of every transaction in a ledger, but as dramatized in movies about financial scandals like Inside Jobs, even a single tampered entry can lead to massive investigations and widespread fraud. Blockchain, however, is designed so that no entry can be erased or manipulated. Instead of relying on a single institution, the ledger is maintained across many computers. There are miners and specialized machines that verify every transaction step by step. If an error is detected at any point, the transaction simply isn't approved. This decentralized verification process means no one can alter the ledger without consensus. Because blockchain is still a relatively new technology, the cryptocurrency market is likewise emerging and highly volatile. With a small market size, prices can swing dramatically due to the actions of a few players. Yet, as with any groundbreaking technology, think back to the early days of the internet, initial skepticism gives way to widespread adoption over time. So as technology and trust build, what do you think the future holds for cryptocurrencies? Let us know in the comments. If you enjoyed this video and found these 5 core concepts helpful, please like and share so that others can also learn about the game of cryptocurrencies. And if you're new to the channel, subscribe and click the bell icon so you never miss an update. I'll see you in the next video. Until then, stay self-made.